Hi everyone, welcome to another update on the stock screener. Today we're going to talk about 10th Avenue Petroleum Corp. This is a new junior that I found, and I think this is a very good company to invest in. We are in an oil bull market, and I'm going to tell you why. Let's look at this chart. It's just going up. It's making a bottom formation and is about to go to new highs. Okay, let's talk about the oil market first. So you can see here that oil has bottomed out, and this is a very nice spike. I think this is going to go to 100. Today even it's up 2%. Now why is oil going up? So when you go to my blog, you can click on the oil forecaster, and it's actually not that bullish yet. It is still in the negative, but this could go into the positive. So let's open all of these links so we know what the outlook is. Okay, so the first chart, net production of petroleum products, it's up. So that means that the economy is actually not doing that bad. Production is up here as well. Production is up, but it's flattening out. Stock levels are very low, so it has come down and it's at a very low level. That's bullish for the price. Distillate demand, look at the stock levels. It's at an almost all-time low here. Demand is actually up. Okay, so the distillate demand surprisingly is up. So there's not a lot of demand destruction, even at these high oil prices. Same with gasoline. Gasoline is bottoming out. Stock levels are very low. It's an all-time low here based on the 5-year range. And demand, let's look at demand. Demand is up. Amazing, right? With these prices, the demand is still up. For crude oil, the same. We are at the low end of the stock levels. And demand is very high. So there's no demand destruction. The forecast says that production is going to go down here, while demand is still going to rise. So we are going into deficit by next year in Q1. So that's a good outlook. Oil will probably be very strong. Baker Hughes crude oil rigs are flattening out. So it's not going up anymore. That means less production, higher prices. Natural gas also flattening out, production not rising that much. Yeah, natural gas is supply has a little dip, and we are going into the winter season, so demand will rise. Here the product supplied, it had a dip here, but we're going back up. So the economy is not crashing like in 2020. We are actually very stable. So I think this is a good environment. We also have 2 million OPEC cuts. Saudi Arabia and Russia are going to cut. And we also have SPR release to end in November. So very bullish signs. Now, let's go over to our our valuation chart. Let's see. Where are the minus here? And we're going to look at 10th Avenue's valuation. So currently we are at a market cap of 11 million CAD, that's all CAD. A bit of liabilities, but no real debt. Price to book is at 2. That's actually very good for junior. PE ratio is 15, but this will come down very fast. Cash, they have 1 million cash, which is a lot for a junior. The equity is at 5 million. That's really high. And it's confirmed here, 5 million equity for junior, trading at 11 million. Earnings. Then we have, for next year, we have an EBITDA of around 7 million. So this is trading at 2 times EBITDA. That is very cheap. These are the fully diluted shares. And important, they have 17 million in tax pools. So that means they don't need to pay taxes on 17 million. That's a lot. When you compare this with the earnings that they have and the market cap. So very good, perfectly to grow. Then what's the cost? AISC is calculated from the realized sales price in Q2, which was 117. That's this number. Okay, that's from second quarter. And they achieved a net back of $60. So that's the 60. And with that, we can calculate the costs, which is about 56. Production is 250. So this is the production of 2022, 250 barrels per day times 365 days. I added 38 to this because they just made a new acquisition in September. That's not added here yet, with an additional 38 barrels per day with a very high netback of 67. So better than this one. So that's the 38 here. That's for 2022. Now for 2023, which is next year, we have 250. So that's already 2022. 2023, that's this one. That's 450. So here is 450. I took 430 because it declines. Plus the 38, okay? And then for 2024, we add another 250 to that because they have acquired 35% from that acquisition. And there's one well in there that has around 700 barrels per day. So 35% is 250. So I added the 250 to that as well. And of course, this here, this is the Swan Hills property. They think that this is going down, but actually this will be growing. But they can't say it because it's operated by Canadian Natural Resources Limited. But they are going to increase the productivity by increasing the water injection. So this is probably going to rise in the future. So I added some to that as well. So that gives us the following chart. So current oil price in CID is 121. It's about $90 oil. And the valuation is using this cost number, using this oil price. And I did a conversion factor here, divide by 148, which was the oil price in Q2, and times 117, which was the realized sales price. So that's the conversion factor times the current oil price minus the cost, and this is the production for 2023 with a multiple of 5, and we get 34 in valuation. So that's this number for next year. So that's next year. And there is this upside for 2024 based on this production. Okay. So we are looking at already a double based on these numbers, these 200 numbers. So that's for 2022. We will go to production of 250. So that's this. And by next year, we go to this and then this. So you can easily see this is going to triple, okay, at the current oil price. If we go to, let's say, $120 oil, in CID it's 165, then this is the upside. I think that oil can go up much more, at least 100, maybe 120. But you can see already that there is a 6-fold, 8-fold upside to this company just by oil going to 120. If we go to 150, that's about 200 in CAD. Then you'll see that in the long run, we can have a 10-fold. Of course, the oil price can also drop, let's say to 60. Then we have another scenario, of course. So this is $50 oil. So then we have downside risk. Okay, so it all depends on where oil is going to be. But at current oil prices at 90, we have upside. And we all know that oil is probably going to go up. So we buy this. If oil starts to decline, then of course you need to start selling. Very interesting play with a lot of production growth, no debt. And yeah, do your own due diligence and decide what you want to do with this. And I'll see you in the next video.